Envision. Talk to me. Why? I mean, we knew you were short this name. I think you had revealed it before. But why sort of reiterating it today? Why are you still short this name? They have a deal with KKR.
Right.
Do they not?
Right. And we think the risk reward is very interesting because we think it's a non-negligible chance that the buyer may take another look and figure out what they've done.
Oh, you think the deal may not happen?
I think the deal may not happen. No, most likely it will. Thus the spread. But as Steve and I were just talking off camera, the risk reward is kind of interesting given what we see as the realization. So in my presentation, I talked about PPM 1.0. Now, sadly, I'm old enough in this business to see these things come and go. In the mid to late 90s, there was a company called Ficor. They went broke.
Yep.
It led to 8 or 9 other Me Too companies that went public in the PPM business, which is physician practice management. This is the business of buying doctor practices, signing the doctors up for basically 3 to 5 years to a reduced salary, and then capitalizing that, and then rinse, repeat. The problem, of course, is that at the end of 3 to 5 years, the doctors want to get paid more. And you either have to pay them more, thus hurting your margins, or you have to re-up a contract and capitalize that. In effect, what these companies do is they capitalize salaries up front. It's just that simple. If you look at the business model, in the late 90s, when the contracts rolled off, because every doctor and his brother and sister wanted to sell out to these guys for obvious reasons, the public markets got wind of it and shut off capital,
right?
Since they were all negative cash flow businesses, and 8 of the 9 public companies went bankrupt.
When you sat down, Weiss said to you, I don't get this short. You want to expand on, where that comes from and have Jim, I mean, we can have a little mini debate on this.
Right.
You know much more about the company than I do, Weiss.
Right. So I went through the proxy. We were involved with Team Health because we thought that Blackstone bought it for much less than it's worth. It went out at $43.50. Actually, Envision had an offer 8 months before Blackstone bought it at $70 on a stock-for-stock basis. So it declined. I wasn't in love with the business. I thought that Blackstone got it very cheap. I've kept pace with it. There was conference calls for bondholders, and it's going okay. But after I said that, Jim,
where are the bonds?
Well, yeah, I know. Well, the bond, it was too highly leveraged. It's got 7 turns of leverage. Ridiculous.
The bonds are at 85.
Yeah.
Okay.
So, but I'm not. I wasn't in love with it. But
do you think Blackstone would do that deal again?
No. But they had taken it public originally. But in any event, in this short, it actually occurred to me if I said I don't get the short, but I get the short. And here's why. I know what my downside is. My downside is deal price. That's $45. If the deal breaks and it'll cost Blackstone a couple $100 million to walk away, they may say it's
KKR.
KKR, I'm sorry. The other thing about these companies, which I don't like, is if you go into an emergency room, chances are it's outsourced completely to either Team Health or to Envision. And guess what? Anybody walks through an emergency room, you got to treat them. Guess what? Bad debt expense, 14%. Any company that runs a bad debt expense like that is in trouble. So
Jim,
I don't disagree with
you would hate a roll-up in any sector, right? Like you just
No, not necessarily, Josh. What I want to see is the business itself, right? And there are roll-ups that basically give scale in businesses where you can actually cut the overhead, right, and just add the operating profits to the business. There are others where the roll-ups are done for accounting reasons. And PPM industry, they're done for accounting reasons. They're done specifically so that you can actually capitalize the upfront salaries and then make the business look more profitable. Because I used an analogy in the other room of Josh and Steve's burger chain. Okay, you have one burger
opening
operation.
this fall.
Okay, and so say it's not profitable. It's just a single shack. And the two of you pull 50 grand out a year, you're working 6 days a week, 16 hours a day. I come in and say, you know what? I'm going to play a little private equity magic with you. I'm going to buy your burger stand for 100 grand. I'm going to sign you guys, you got to run it for me for 5 years. And in exchange for cutting your salary to 50,000 from 100 combined, I'm going to pay $500,000 for that contract.
Right.
So I'm going to pay you $600,000. You're going to take a $50,000 cut over 5 years. You're going to say, wow, that's fantastic. Sold to you, I'll be your employee for 5 years, right? I'm going to tell my investors, since I'm going to capitalize everything, the business is now cash flowing at $100,000, and I just paid 6 times for
But
it.
can't you come in and give us a lower weighted average cost of capital, give us maybe a marketing budget, combine us with another burger chain, and make the two
No,
act
because
better?
it's
You
a body
literally
shop.
can't do it.
It's a body shop. It's,
Right.
it's doctors.
So,
And so just let me finish the thought.
Please, yeah.
So what I've done now is I've told my investors I've bought this business for 6 times cash flow. It's nonsense, because the minute your contract is up, I'm paying you guys, and the business is not profitable again. And this is the problem with the PPMs. In order to stop that erosion of contracts rolling off, they have to buy up more doctor practices. And if you look at the numbers in my presentation today, it's exactly what's happening.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.